Introduce myself, I'm Bruce Haas.
I'm Sally Lynn.
Mike Miller.
And Reed Swartz.
And as you know, we are here to do the corporate valuation of Rock10 Corporation. So we're going to give you a little business background first. They're a manufacturer of packaging products, so they're mainly focused within the United States. About 90% of their operations are within the U.S., while the other 10% is abroad. And we think maybe moving forward, that is an area for growth with them. We're going to go into the revenue segments in a little bit, but recently Rock10 has been expanding a lot through acquisition. Most notably so, Smurfit Stone in May of 2011, which kind of really changed their composition of their business, and it was really driving factor moving forward. So as you can see from the graph, their revenue is mainly from corrugated packaging and consumer packaging, while a small sliver is from recycling and waste solutions. So currently, our recommendation for Rock10 is a buy. We believe that the intrinsic value of the stock is $86.67, while the current market price is $83. We calculated this price through three different valuation methods. We took the arithmetic mean of these three, and I'm going to let Sally go into a little bit more detail about the first method that we chose.
So now I'll begin by telling you first about the relative valuation approach. For this approach, we looked at 25 firms within the industries that Rock10 operate in, and we assessed them for comparability based on size, market share, and type of firm. For our analysis, we focused on domestically located firms with publicly available information. And of these 25 firms, we found that 9 of them were comparable to Rock10, which we then used for our analysis.
So as you can see, the industry, we use those comparable firms, those 9 firms, and we wanted to see exactly where Rock10 stood in terms of the historical growth, the future projected growth, its beta, its debt-to-asset ratio, and its market capitalization. And we found, on average, as you can see from the blue highlighted numbers, that Rock10 fell in the average within those comparable firms. So we were able to use this as a factor to find what our intrinsic value for the stock was.
So after we determined that Rock10 fell within the average based on comparable firms, we then calculated 6 different ratios using the financial information from the comparative firms. And after using Rock10's own financial information, we calculated the stock price to be $93.51 based as an average of all the average ratios.
So next we'll get into our discounted cash flow method. Our first step in order to calculate this was calculating the weighted average cost of capital in order to get a discount rate to discount our free cash flows. First and foremost, as you can see, we calculated our risk-free rate at 1.63%, which was taken as the U.S. 10-year Treasury bond. Our return on the market was 10.64%, which is just the historical average of the S&P 500. Our current beta of 1.318 is a 1-year daily regression. So we also calculated a 3-year weekly regression and a 5-year monthly regression. But we used the 1-year daily regression because this was the only one that fully incorporated the acquisition of Smurfit Stone, and it reflected the most recent data. Our pre-tax cost of debt was 4.15%, and this was taken as the U.S. historical, or the U.S. BBB minus industrial average, and then we calculated our weighted average cost of capital of 9.06%.
Okay, moving forward from the calculation that Reed just discussed of WACC, we built our discounted cash flow model. We had 3 main assumptions that were involved in our discounted cash flows. First was our sales. We developed a 2-stage model, which we compared our sales to other various sources along with our own analysis, and developed that Rock10 will grow at 5% in 2013 and 2014, and then will decrease marginally to 4% in 2015 through 2017. Moving on, for our EBIT margin, we assumed a rate of 7.4% for the first 2 years, and then 8.4% in 2015 to 2017. We developed this because we looked at the historical EBIT margins from 2007 to 2012. However, in 2011, during the acquisition, and 2012, the EBIT margin suffered because of Smurfit Stone's poor performance in those most recent years. However, we expect Rock10's management, along with the synergies, to increase the EBIT margin back to the historical levels, and will reach 8.4% in the later years of our projected cash flows. Our third assumption is our capital expenditures. We developed a rate of 2% based off our historical cash flows average. Another assumption that went into our DCF analysis was our depreciation. We took the average depreciation and the average revenues over our historical years and developed a rate of 5.275% based off sales to project our depreciation. Our final assumption was our net working capital change, which is 0.2% of sales, which is again based off our historical average of the cash flows. And as you can see here are our free cash flows and the present value of them. So using our discounted cash flows, we used both the perpetual growth and the EBITDA multiple method to obtain our intrinsic values. Such assumptions were our WACC of our 9.06%, our terminal growth rate of 1.8%, which is a conservative approach which reflects U.S. inflation. Our EBITDA multiple of 7.45 as our multiplier was taken by our 9 comparable firms that Sally and Bruce discussed. We took the average because we wanted to coincide with their relative valuation. Since they believe that ROC10 fits in the average within the comparable firms, we wanted to use the average of those comparable firms. So our multiplier is 7.45. Moving on. As you can see here, using our perpetual growth method, we took our free cash flows, calculated a terminal value based off our growth rate, and obtained an intrinsic value per share of $75.25. Using our EBITDA multiple of 7.45, we did the same steps, but using our new multiple, and obtained an intrinsic value of $91.25.
So next you can see that we conducted a sensitivity analysis on the intrinsic value per share based on the perpetual growth method. So under our current assumptions of the 1.8% growth and the 9.06% WACC, we calculated the share prices of $75.25. So as Mike had mentioned a little bit earlier, the 1.8% is a little bit conservative. So if we were to go with a less conservative measure and increase that growth rate to, say, 2.3%, then our share price would increase to around the mid-80s. And those blue numbers are the ones that we believe could be probable intrinsic values. Our next sensitivity analysis was on the EBITDA multiple for the intrinsic value per share. Under our current assumptions of 7.45 times EBITDA multiple and a 9.06% weighted average cost of capital, we calculated the share price of $91.25. So if ROC10 were to outperform and increase their EBITDA multiple, we would see that share price increase to the low 100s.
Moving forward, we did a ratio analysis. One of the main ratios we discussed were our profitability ratios. As you can see, one discrepancy here is that from 2007 to 2012, the gross profit margin increased by a substantial amount. In 2011 and 2012, it decreased. So we attribute this to the acquisition of Smurfit and how Smurfit underperformed before the acquisition. And now we see that ROC10's management, along with the synergies created between the two, will help the gross profit margin increase in our projected years, which is reflected by our EBIT margin increasing in those years. As you can see as a whole, though, ROC10 in 2012 was outperformed by the industry. Other ratios that we conducted were our liquidity ratios. ROC10 has performed very consistently over those. A downfall is that their accounts receivable turnover has decreased over time. This shows that either credit policies may be lacking a little, and their efficiency of collecting their accounts receivable payments has decreased over time. A good note is that ROC10, with their debt ratio and their debt to equity, has decreased over time, showing that ROC10 holds less debt in comparison to their total assets and their shareholders' equity. And as a benefit, their payout ratio, basic and diluted, has increased, showing that shareholders are receiving more dividends per earnings.
And finally, we'll conclude with our investment risk and business risk. So first and foremost, we have the input cost fluctuations. So they obtain their raw materials from external sources, and this is more than likely a downside effect, so we expect those prices to increase. Also, there's intense existing competition and competition from foreign entrants. So the Asia markets are becoming a lot more competitive, which is decreasing overall sales prices for ROC10. Next, we have the integration risk of acquisitions. So most notably the Smurfit acquisition, because it was so large in nature. We classified that as a neutral effect because we're not exactly 100% sure whether or not they'll be fully integrated. And our government regulations, so more than likely it'll be a negative effect. And then finally, our potential growth into emerging markets. As Bruce was mentioning earlier, there are a lot of growth opportunities overseas for ROC10. So this concludes our presentation, and we'll now open up the panel for any questions. Thank you.
You mentioned the integration risk of the acquisition, and then also, can you speak a little bit more about that as far as maybe its effects on the margins you expect to see or may not see?
Yeah, so y'all can expand on this a little bit if you'd like, but the integration risk, so Smurfit obviously was not performing very well at the time of the acquisition, but we fully expect Rockton's management to fix these problems as evidenced by our EBITDA margin, or our EBIT margin, which is slightly increasing because we expect the management to fix the problems and they'll grow as a company.
So we see both benefits and potential opportunity areas for Rockton with the acquisition, because with the acquisition it completely sort of changed the game because it doubled the size and eliminated a key competitor, so that now Rockton will truly become the market leader. But with that there's a lot of risk in really managing the integration, because if the synergies aren't realized then the acquisition would have been not profitable. So there's definitely benefits to that as far as market share and etc., but there's also a lot of risk involved, and that depends on whether or not Rockton's management can adequately handle the acquisition.
So what can you tell me about the change in the market structure with the acquisition? So how concentrated was it? How many players of size? And then after the acquisition, how concentrated is it?
We didn't really look that in depth on it, but we do know that it doubled the size of the company. So I think just purely on that fact, it's a huge game changer.
Well, another aspect is that their Smurfit Stone, the acquisition alone, increased their corrugated packaging sector, I think from just below 10% to well over 40%. So that alone, as a revenue driver, has shown that the acquisition has benefited at least one of their segments substantially.
And Rockton believes that's going to be a huge revenue driver for them in the future. That's kind of the reason they went out and got Smurfit Stone when they could, because they think that is going to be kind of really propel them in the future more than their consumer packaging.
In addition, because it's a commodity, really what's important is just the scale of it. So with this acquisition, we're assuming that the economy of scale would really help Rockton out, because they can't really charge a high profit margin on their products since it is a commodity.
So what can you tell me about the sorry, I lost my train of thought. Go ahead.
You have a top line growth rate of 5%. What's your assumptions for that?
We compared various sources. Some include Bloomberg, Value Line, Zacks, our own analysis, and several other investment sites. And we saw various assumptions for the growth rate for long term. We wanted to take a conservative approach, considering that revenues alone in 2011 grew 73%. In 2012, they grew at over 70% again. But we assumed that the acquisition of Smurfit Stone has already been absorbed into the company by their fiscal year end of September 30th, 2012. We assume the revenues to grow at the 5% in a two-stage model for the first 2 years, and then at 4% in continuum for those last 3 years of our projected cash flows.
So really with the acquisition, it's not so much that I think that the revenue would change, but really the cost. We're expecting the cost will decrease since with the economy of scale. And because the market is so competitive and already saturated, that really the opportunity area is maybe to expand abroad and tap into those markets, even though there is competition there too.
So what I was going to ask is about the price paid. Do you have an opinion on the price paid for the Smurfit acquisition?
Well, not specifically, but as I mentioned earlier, Smurfit was obviously underperforming, so they were able to go out into the market and pay a much less expensive price than maybe what it was valued.
You think it was smart?
I believe so. Specifically, just looking at share price over the past few months, back when we started our valuations in September, they were running high 60s, low 70s. Yesterday, it traded around $86. So I think Rockton's management as a whole is really starting to integrate Smurfit Stone into their company, and they have seen great profits over those acquisition years, and now I think they are a much more stable company that has been able, as Sally said, to control their costs, and them as a firm are seeing the benefits of their share price increasing specifically.
And it's evident by the lower debt to asset ratios, et cetera, that there's less risk in the company overall.
And I mean, you can compare the 2011 financial statements. I mean, at that time, I'm sure a lot of investors were not thinking that was such a good idea, but they've developed, and then their 2012 financial statements got a little bit better, and we expect the 2013 financial statements to get even better, and that just comes with the integration because it's such a large acquisition.
So like a year from now, what kind of data point would you want to be looking at to kind of confirm or make you rethink your recommendation?
I think we'd
You
like...
don't all have to agree. No.
My opinion, I'd like to see the gross profit margin. That's a big factor for me specifically because in 2007 it was 17%, and then in 2010 it got up to just below 24%. However, it dropped down to 16% in 2 years from 2011 to 2012. So that's almost an 8% difference in gross profit margin. In 2013, assuming that the management has effectively fixed problems and the integration and synergies created, I'd like to see that their gross profit margin turns back and starts an uptrend again. And that would be a good driver for me alone to see that they are becoming more efficient in cutting costs and increasing their revenues.
And I'm kind of interested in, where their sales go, right? In the past year it was 72%, obviously, because huge acquisition. So I would like to see how the synergies within the acquisition kind of move forward. If it's going to be 5%, if it's going to be higher, then this, our intrinsic value of the stock could be raised up a lot. So I think that that's something that I would be looking forward to in a year.
And if I could touch one more point, seeing that Rock-10 was rated at a BBB minus rating, which is our lowest investment grade rating, we'd like to see that the company as a whole increase their overall credit rating, seen by their increase in share price, their overall cut of costs, their debt ratios are decreasing and stuff like that. So if they could increase their credit rating, their WACC could decrease, and you could see even further higher share prices in the future.
So what are the overall drivers of the fluctuation in gross margins? So you were saying that the gross margins fluctuate a good bit.
Mm-hmm.
So what are the drivers of these gross margin changes?
The problem that I saw from the years that they decreased substantially in 2011 and in 2012 were the costs. The cost of goods sold, there was a lot of discrepancies with the acquisition that they needed to learn how to properly integrate the two companies and create a synergy and manage these costs. And revenues were increasing by 70% in those 2 years. So obviously costs were increasing at a much higher percentage than that. So that alone was one of the main assumptions as to why their gross profit margin decreased so much.
In addition to the acquisition, I think historically, because it is the industry that it operates in, and it is a commodity, it depends on a lot of cost of goods sold. And I think in years we've seen fluctuation in just the basic cost. So perhaps they could use some sort of hedging to make sure that the cost stays the same. Any other questions?
Do you want to speak about the quality of the company, the debt rating that you had kind of mentioned?
Well, when I showed the ratio analysis, specifically with their debt to assets and their debt to equity, their debt to assets went all over the place from 90s back into the hundreds, been down. Yeah, we can go to the actual slide. Actually,
that was really, why do you think, do you have any concerns about this company?
In future years, I think the idea here alone is that historically they have shown that they've decreased their debt in comparison to both assets and shareholders' equity. In the future periods, I'd like to see if they can maintain that, determining whether how they management goes about financing things in the future, whether they're going to change their structure using more debt or issuing more equity, and that's something that I'd like to look into in the future as well.
In addition, I think it has to do with their choice of expansion. So historically, they've always expanded through acquisitions and et cetera. And so I think while that's an opportunity, that could also be a risk with taking on debt to acquire another company. So they have to do a really good analysis how much the firm's actually valued at and make sure they don't overpay.
That's time. Is that time? Okay.
Well, thank you guys for
Thank
your
you.
questions. I
Thank you.
appreciate it.